Hello everybody, Professor J here, and today we're going to talk about accounts receivable and the allowance method of accounting for those accounts we don't think that are collectible. So, first of all, it's good to remember that the financial statements do not show the amount of cash or actual assets that a company is holding. What they show is value. There is a difference. So financial statements show the value of a company. So if we have $100,000 in our accounts receivable account, we know it's not really worth $100,000 because we're not going to be able to collect all that. With that being the case, we are required by GAAP to show the value of our accounts receivable, which is not the same as what's actually showing there. So, there are different ways to do this. First of all, there is something called the direct method. The direct method, however, is non-GAAP. It does not comply with GAAP. A lot of very small non-public companies might use this method. But here's how the direct method works. They wait until they know they can't collect on an account receivable. They might have an idea up front, but they don't know for sure until they actually try to collect it again, try to collect it, and the person just isn't paying. In that case, they write it off directly to expense. So let's say there's $4,000 sitting in their accounts receivable. They would have marked it to revenue already earlier when they put it down. So now it's 6 months later and the person hasn't paid, or 9 months, whatever. They know they're giving up. Here, they have bad debt expense. What they do is they just take it straight out of accounts receivable and expense it. The journal entry for that would look like debit bad debt expense for $1,000 that they couldn't collect, and credit accounts receivable for that same $1,000. They just write it off directly to expense. Makes a lot of sense. However, it's non-GAAP. Why is it non-GAAP? Because it violates the matching principle. What does the matching principle say? The matching principle says that expenses are supposed to match the revenues that as they come in. Well, we took our revenue in this account receivable and marked it to revenue 6 or 9 months ago. And now, several months later, when we finally give up on collecting, we're expensing it. That is not considered matching revenues and expenses. So it is a non-GAAP method that only if you're not publicly traded could you even consider doing it this way. So, with that in mind, let me cover just a slightly different subject. And that is the different names for bad debt expense. So, obviously, we have bad debt expense. But what you're going to find is this is interchangeable with also the name called uncollectible account expense. And yet another name, just to keep you guessing, is doubtful account expense. So there are 3 different names that you can find the exact same thing called. Now here I used bad debt expense because a lot of times under the direct method, that's just what they like to use. However, they can also use uncollectible account expense. But could they use doubtful account expense when using the direct method? Not really, because Is it doubtful that they'll collect? No, it's not doubtful at all. They know. They are certain they're not going to be able to collect it because they've already tried and they can't. So if they use the direct method, they're probably only going to use one of these first two names, bad debt expense or uncollectible account expense. Generally, you'll see actually uncollectible account expense. Okay. So now you know how not to do it, the direct method. In this class, most often, you do have to understand the direct method, but most often we're going to use the allowance method. So let me clear all that off and show you the gap method of doing this.